Let's get the street's take on this market. Sam Stovall, CFRA Research Chief Investment Strategist, joins us now. Sam's S&P 500 price target for the year end is 65.85, so higher than where we are right now, Sam. But does the market look vulnerable? Couldn't even hold this morning's bounce back rally, and now the Nasdaq's down 1% as we speak.
Good morning, Sarah. Yes, the 65.85 was our 12-month target that I established back in late November. And what we do is maintain a 12-month target because that gives guidance for our CFRA equity analysts to decide whether the stocks that they follow should be overweight or underweight. Right now, that target has not changed, which would imply that we have reduced the December target to 64.90. So I think there is more concern ahead, as we've been seeing a reduction in earnings estimates for 2025 by about 300 basis points, mainly because of the strength, the pull forward of orders and whatnot for the Q4. So I think that investors are getting a little more cautious at this point.
And you think that makes sense? Because on the flip side, you know, the data hasn't really deteriorated. There's some cracks. And you have a Federal Reserve that says it's willing to step in and cut rates again if things weaken.
I think that there's still the concern about how aggressive the Fed will be with interest rates. I mean, we are looking for at least one cut, if not two, this year, but that's certainly lower than the 4 that started the year. Also, you have to remember that in the 12 months leading up to the first rate cut, while the market was up an average of about 19%, in the 12 months after the first rate cut since 1990, the market was up only about 2 to 3%, mainly because wishing is a lot more profitable than having. And usually what we find is that there are a lot more challenges than had been anticipated.
Are there areas in the U.S., Sam, that you think are proving to be defensive enough? Are you more interested in looking to see what's ex-U.S.?
Hey, Carl. Well, certainly in the past week, we've been seeing about 6 sub-industries that have moved above both their 50 and 200-day moving averages, in a sense, bucking the trend. So areas like biotechnology, consumer electronics, diversified REITs have done fairly well. But we are seeing rotation overseas, mainly because we're looking at double-digit relative PE discounts to both the developed and the emerging markets. And so I think investors are looking to where the greater profit potential and improvements lie.
But I guess the key question on the Nasdaq, as we watch this slide for names like NVIDIA ahead of earnings, Microsoft, Broadcom, Palantir down 10% right now, has the fundamental case changed around the secular AI growth story with things like DeepSeek or questions about CapEx spending? Has anything changed? Because that's the key leadership area and also the biggest weight in the market.
Well, according to our tech sector group head, Angelo Zeno, our belief is that the longer-term story for tech remains intact. Yes, near-term, because we had been bumping up against a PE ceiling, and that most of the growth would really come from earnings improvements rather than multiple expansion, that we are going through sort of a digestion phase of technology. But the belief is that it's still likely to be a leader 12 months and longer from now.